So Les, earlier in our conversation, you mentioned there are different types of lenders, and but there's also different types of loan programs, right? For example, when we were talking earlier, you were mentioning the differences between adjustable rate mortgages versus fixed rate mortgages, and different durations of loans. So, could you talk to what could a business owner expect the options he's going to be seeing or should be expecting to see to consider what loan would be best for them?
So, Byron, let me just kind of add to what you just said in one way. So you were talking about business owners. So there are actually two types of loans that are done. One is a business loan, which is a loan to a business, possibly collateralized by equipment, real estate, and the like. The other would be a loan against the building. Now, the building could be owned by the business owner, but there are actually two ways to go about it. So I just want to point that out to the audience, let's call it, that many people become the owners of the real estate themselves, and then they rent to their business. Other businesses take the loan themselves, and it's the cash flow from the business that's going to service the debt as opposed to rental income. So I hope it's not too confusing to the group, but I just want to point that out. So now in terms of different types of loans and the like, yes, there are. There's what we call adjustable rate loans, which mean that the rate adjusts as prime changes or as LIBOR changes or as a new index called SOFR changes. Others are called fixed rate loans. Now, interesting enough, most private loans are fixed rate. So, for example, you might have a private loan at 10% interest. That's interest only. And so on a $100,000 loan, you'd be paying $10,000 a year of interest. You might have a bank loan that's at 8% interest, that's amortizing for 25 years. And you're then paying principal and interest as you're paying it back, even if it's only 2 or 3 or 4 year loan. So it could actually cost more for that 8% loan than it is for the 10% private loan. Why? Because it's interest only. Secondly, many of the bank loans are based on prime. So as prime goes up, those loans go up. So you might find during the middle of the loan, rates going up. So sometimes private loans actually might be a better solution than a bank loan that seems better to begin with.
Mm-hmm. Yeah, that's a good point. We're in interesting times right now with regard to interest rates, and so it kind of mixes up a little bit conventional thinking as far as how perhaps different loan types are attractive or what their different strengths and weaknesses are. And right now, with Fed raising rates like they are, it makes those adjustable rate mortgages a lot less attractive than they were just a year ago.
So you are 100% right. Times have radically changed, and I think there are a lot more alternatives for people. And again, one last thing, it's certainly a lot easier to take a private loan than it would be an SBA loan or or a loan of that type. But I must say this, that there's a big misnomer about the SBA. Most people think the SBA is impossible to deal with or whatever. If you know your way around the SBA, they're not impossible to deal with. They're very good loans to take, et cetera. But, again, you have to know what you're doing. But again, SBA certainly is a good alternative for small businesses.
For sure. Right. They require less down, which is a big benefit for them. One other factor that I think is interesting that plays into, comparing private money loans with more traditional or more conventional bank loans, perhaps, would be prepayment penalties, right? Sometimes your SBA loans or other bank loans will have some longer prepayment penalties, even with an adjustable rate. So you're kind of stuck with those higher adjustable rates because they have a penalty. And whereas some of your private money loans may not have prepayment penalties or may have much shorter prepayment penalties. On the flip side, there is the downside of some private money mortgages is they're generally shorter term. So you have a little bit more risk that I know we saw this happen back in the Great Recession, when there was the credit crunch and the credit crisis and the subprime mortgage meltdown and then the mortgage meltdown, right? It just kind of cascaded into bigger and bigger things. And we saw that people had adjustable rate mortgages or that they had short-term loans with balloon payments, and they went to go expecting to refinance. And there wasn't refinance available, the equity wasn't there in the property anymore, or the bank wasn't lending and no one was interested in refinancing that loan. And then they were stuck with a balloon payment due that they couldn't refinance out of. And so that's certainly something to be considering when you're considering the term of the loan as well, right?
Yeah, exactly. So again, we just had the pandemic. So a lot of people that had short-term loans found themselves having financial difficulties because they couldn't open their businesses and their loans are coming due. So at the end of the day, there is certainly something to be said for long-term loans. There's no doubt about it. But again, as you're pointing out, a long-term loan in most cases will have a prepayment penalty. The SBA is a good example. Generally, they have a step down, what is called a step down prepayment penalty, many times 5, 4, 3, 2, 1. 5% penalty the first year, 4% the second, 3, 2, 1. So that means over 5 years period, if you wanted to get out, you'd have to be paying a penalty. So a lot of thinking has to be, am I looking for short term just to get me from point A to point B, or am I looking for a permanent loan? So, certainly something very good to be said about permanent loans. Conversely, bridge loans or private loans many times are where you want to be because you only want a short-term loan because I'm making this up that your property is only 25% occupied. You're not going to qualify for the bank yet. The bridge loan basically gets you enough time, a couple of years to tenant your building up. It's fully occupied. Now you can go to the local bank and get a long-term loan at much, much better rates, that type of thing.